You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Ocado, Barratt Redrow, Trustpilot, Experian, ASML, and our US company of the week is Netflix. Sam, do you want to kick us off with Ocado?
Yes. So, I'm sure it's a business that needs no introduction. Ocado have come out with their half-year results, and revenue was up 13.2% for the half to 674 million, with underlying cash profit up 76% to 91.8 million, ahead of expectations. Given an accounting change, Ocado retail financials are no longer included in these numbers. So this is just the pure actual Ocado business, where it's building out the warehouses and the robots and all that stuff. So up 13.2%. Ocado Retail, however, the 50-50 joint venture with M&S, saw a 16.3% rise in revenue to 1.5 billion. The business is still loss-making, and they recognised an 8.5 million loss as a result. There was a free cash outflow of 83.2 million for the half, an improvement on the 170.9 million last year. Net debt was up 9% from the start of the year at 1.05 billion. There was no change to full-year guidance, which points to mid-single-digit percentage revenue growth for the logistics business and around 10% growth for the tech solutions business. Shares rose 13% following the announcement. Customer numbers on the retail side have gone over 1 million, and probably worth mentioning I'm not sure how well this bodes for the joint venture, but there is potential legal action between Ocado and M&S. So essentially, when M&S purchased 50% of Ocado Retail, 190 million of it was conditional based on them hitting certain targets. Those targets weren't met, and Ocado basically are arguing that they weren't met because of the pandemic, so it's not their fault. Whereas M&S are arguing, well, you didn't hit them within the time period, and that's just tough. So I don't really know how that will go, but my understanding is that if it does go to court, when it is decided, it will be an all or nothing thing. There's not going to be a settlement amount. They either probably will owe it or they don't. My concern with Ocado is the free cash flow. So they had an outflow of 83.2 million. That compares to 171 million a year ago. The debt's now 1.05 billion. And they're expecting a full year underlying free cash outflow of around 200 million. In terms of the actual cash on the balance sheet, they've probably got enough to last them about 3.5 to 4 years. So they probably are actually okay in terms of cash at the rate they're burning. They would probably get another year if they got that payment from M&S. However, I just think the debt pile, even if it does start making profits, the debt pile could be pretty big unless it becomes very profitable very quickly. So I would be concerned about that. In terms of the valuation, the business has no earnings, has no dividend, trades at a forward price to sales ratio of 0.55, and that compares to a 10-year average of 2.69. When you look at the share price, it's now trading at about £3 a share. It was about £25 at one point and was in the news because it had overtaken Tesco. That market cap has now dropped all the way down to 2.5 billion. I think these results are okay. I think in terms of the business performance, the business itself seems to be doing fine on the logistics side. However, the debt is concerning. I don't think they're in immediate danger of running out of cash, but I do question how they're actually going to repay this debt. And it is still just by nature a very capital-intensive business. Despite the near 90% drop in the share price, I still just wouldn't touch it because I don't see how the shareholders get a decent return. What about you, John?
Yeah, no, similarly, I think far too risky for me, and I would worry about it in the next couple of years, really.
In that case, should we move on to a business that's safe as houses?
Well, yeah, I was going to say bricks and mortar, but yeah, safe as houses. So Barratt Redrow, it's one that I actually own. They had their full year results out last week with Barratt Redrow's average weekly net sales rising 16.4%, 0.64, with the average selling price rising 2.8% to around 380,000. 16,565 new homes were completed last year, below the group's 16,800 to 17,200 guidance range due to softer than expected demand for its London homes. The order book improved to £2.9 billion, whilst build cost inflation remained broadly flat. Barratt had a net cash position of around £772 million at the year end. The integration of Barratt and Redrow delivered £69 million of cost savings last year, and this meant that 2025 full-year underlying pre-tax profits are expected to land in line with market expectations of £583 million, despite the shortfall of home completions. Barratt expects to deliver between 17,200 and 17,800 new homes in the new year, with build cost inflation running between 1% and 2%. Due to additional building safety charges relating to legacy properties, 2026 full-year pre-tax profits are expected to be around 640 million, and that was against the previous consensus of 712. In terms of valuation, Barratt Redrow has a market cap of £5.42 billion and trades at 11.8 times forward earnings, with a prospective dividend yield of 4.2%. And the shares were down around 10% on these results. I did think they were disappointing, particularly in the London sector and with the building safety charges, but I do still think despite that, it is solid underneath as the biggest house builder in the UK. You're seeing the cost savings with the merger, and they're managing the build cost inflation well, also has a very decent order book, and it should benefit from the long-term structural demand for houses with the growing population in the UK. And I do think it's reasonably priced at the moment, and you've still got that pretty decent dividend of 4.25%. Sam, what are your thoughts on the house building sector and Barratt Redrow in particular?
I think in terms of the sector, I'm probably still quite bullish on it long term. I think the recent announcements we've had, I don't necessarily agree with them, but you see we've got the announcement where certain people will be able to get mortgages with 4.5 times their income now, rather than the traditional 3.8 or 4 or whatever it was. I don't necessarily think it's a good thing, and I think it is more of another demand side solution to a supply side problem. But I think in longer term, I think whilst it might be softer than expected demand, I just think demand for the houses is outstripping supply by so much that in the longer term, I would just continue to back it.
Fair enough. Would you be interested in any of the house builders?
I do view them as all pretty similar usually. I think with a prospective yield of 4.3%, I probably want maybe a bit better than that. I know that there is decent potential for capital growth if they can start building more homes, and if we get a lot of the promises we've had from the Chancellor about removing red tape and stuff like that. But I'd really want to see it to believe it. So in the meantime, my focus would be on, I probably want a yield more, probably towards like 6%. Yeah, I don't know if any of them have that. I think some of them do, but
yeah.
4.3 seems a bit low to me.
Yeah, fair
enough.
You?
As a shareholder?
As a shareholder, I'm happy to hold it for the long-term reasons that I mentioned and that you also did. In terms of the dividend, I'm just sort of reinvesting it. And if where we are in the cycle at the moment, it doesn't feel like we're anywhere close to the top.
So in that case, what have we got next? Should we move on to Trustpilot?
Yes. How are they doing?
So it is a business we've covered a few times, actually. For anyone who's not familiar, it's the website, the review website, and the way they make money is when you leave a review on the website, you give them a lot of your data. For businesses who are actually getting reviewed, that's quite useful because they basically have a load of data on the customers that have been buying from them or potential customers. So they will sell that data to the businesses, usually with kind of a monthly price to get the information. They have come out with a trading statement for their half-year results, or prior to their half-year results, and they've said that bookings are up 19% year over year to 140 million. Annual recurring revenue is up 29% year over year to 273 million, although they've said it's only 21% in constant currency. So 8% of that's from exchange rate movements, and revenue is up 23% year over year to 123 million. They've said UK bookings are now up 15% in constant currency. Europe and rest of the world is up 19% in constant currency. And North America is up 18% in constant currency. The last 12-month net dollar retention rate was 103%. We've had strong cash generation with the period end net cash of $67 million, down slightly from $69 million a year ago. after executing a $23 million buyback in the half and benefiting from FX tailwinds. I should have said at the start, they do report in dollars, and they're upgrading the full year 2025 adjusted EBITDA margin guidance to 14%. So I think what's really interesting about this is if you look at their growth, well, we'll take it annually. So there might be some seasonal movements, but I don't know. But if you look at their growth from year to year, it has historically been at kind of sort of 18-90%, around 18%. So the growth has actually accelerated to this 20%. As well as that, as the business is getting bigger, the margins are going up. So they said they're guiding for margins of 14%. That's up from 11.3% a year ago and 9.3% the year before. So as you'd expect with this type of business, you'd expect it has the potential for very high operating margins. That seems to be coming true. As it gets bigger, it's becoming more profitable. However, where I have difficulty with this business, because it is a great business, it's a business I'd love to own, is the valuation. It trades at a P ratio of around 240. Price to operating profit is about 175. The price to free cash flow is about 67. I think it's a really fantastic business. I think it's a great business model. I think it's a business that I would love to own at the right price. At a 1 billion market cap, it's not actually, it's still quite small. So I guess that's maybe why people are paying such huge multiples for it. Because if you think it's a business that could be making say 100 million a year, you're getting it at 10 times earnings or 10 times future earnings. And it is just at the start of that journey of actually starting to make profits. But as much of a great business as I think it is, as much as I'd love to own it, I don't want to pay 67 times free cash flow. Because if that growth, especially as well, I know it's growing, the growth is accelerating, but at 22%, it's not huge growth. So hopefully they can continue that. But yeah, I'd just be really nervous paying that price. But it's on the watch list, but it would have to come down a lot before I bought it, unfortunately. What about you, John?
Yeah, no, similarly, a fantastic business, great growth so far. I guess the difficulty is just coming to that valuation, which obviously there's nothing the business can do about that. But as an investor, that's the sticking point. So great one to watch, and fingers crossed it'll do well because it's a British, I guess, tech kind of growth story.
Yeah, I think it is. One of the few.
Yeah, it hasn't relisted yet or been bought out.
Well, it does seem like the type as well, actually. If it's reporting in dollars, it will be a secondary market in no time. But yeah, okay. Should we move on to a cheaper business?
Well, it's not that cheap. It's still quite expensive. And I think it's probably, you could still consider it a British growth story. So Experian, which is a credit rating group, they had their Q1 trading statement out with reported organic revenue growth of 8% over the first quarter against a consensus of 7%, driven by strong performance across the business. In the key US market, consumer revenue growth was held back by some tough comparable periods, which are expected to ease in the coming quarter. Excluding that impact, growth was strong with good demand for credit cards and personal loans. And full-year guidance is unchanged, pointing to between 6 and 8% organic revenue growth. And the shares were up around 4% in early trading. In terms of valuation, Experian has a market cap of £37 billion and trades at 28 times forward earnings, compared with a 10-year average of 25.5%, and has a prospective dividend yield of 1.4%. I think trading statement, obviously a little bit ahead. I think as a business overall, we have covered it a couple of times. It does seem like a very high quality business with good margins and strong demand for business in terms of data analytics, the credit reporting, identity verification, and it has a dominant position in the core US market. It's also interesting, I think, when you make the investment case for it in terms of AI and how that might integrate into a business like this, being able to analyze their vast and unique data sets. I think that's potentially where some future value could come from. I think it is an expensive business at 28 times earnings. It has delivered over the last 5 or 10 years. And it's probably a business that I would quite like in my portfolio. It was a business that was pitched to me probably over 10 years ago. And I think around that time it was maybe 15 to 17 pounds a share. It's now up at sort of 40 pounds a share. So I'm kind of anchored back to that price. And I did take another look around COVID time, because I think it went back to that kind of £17 that I was anchored at. But then everything else was going on. There were lots of other things that were cheaper, and you didn't know what was going to happen at that point. So essentially, it's never gone back down to those prices. And I don't think I'd be brave enough or want to pay up at that valuation for the growth that it's currently delivering. So I don't think it's one for me. Sam, what do you think of Experian and also its current valuation?
I think it's a great business. I think it's unfortunately a business that it took me a while to appreciate how high quality it was. However, I think one thing that actually really did make a difference was I used to work somewhere that had a data breach. I think I started using some of the products after that as a consequence, and I think that made me appreciate it a lot more. In fairness, since we started the show, it's still always been quite expensive. I know it's probably up a third since we started covering it, but I think when you look at the price it was at that point, yeah, I wouldn't be too upset that I've missed out on it, although I think it's a great quality business. I think when you look at the share price performance in the time we've covered it, I wouldn't say it's ever really been at a point where it's kind of gotten into the no-brainer territory. I think, unfortunately, the quality of the business has always been reflected in the price, so I guess it makes it a little easier to stomach having missed out.
And it's interesting when you look at Equifax, sort of comparable business. Experian is now bigger than Equifax, but probably about 25% bigger, and Equifax trades over 50 times earnings.
Yeah, so it's probably the better value of the two, but
yeah, no,
still wouldn't.
I'm not making a case of investing in it because it's cheaper than Equifax, but it's just interesting in terms of comparables in the market.
I think for me, though, the sticking point would be I'm not going to pay 29 times forward earnings. Firstly, for a business that's already pretty big and only growing at 8% a year. I do question as well, what kind of was this trading statement even needed? They've beaten revenue by 1%, and they've basically not said anything else, and the full year guidance is unchanged. So I'm not sure this was needed. But anyway.
Fair enough. Okay, so shall we go on to ASML?
Yes, so it's a business we have covered once before, I believe. However, for anyone who's not familiar with ASML, they are the biggest company listed in the Netherlands. They have a market cap of 256 billion euros. I think that makes them bigger than anything on the FTSE, doesn't it? Unless Shell and BP merge.
So I think I'll just check AstraZeneca. So AstraZeneca has a market cap of 160 billion. So
so this will be bigger. So it'll probably be one of the biggest in Europe. I think Novo Nordisk might be the only one that's actually bigger than it. But anyway, they are a company that make money by selling lithography machines. If you don't know what they are, that's not a problem. Basically, they are essential for manufacturing semiconductors. So they sell their machines to chip makers like Intel, Samsung, TSMC, and they're pretty expensive. They're pretty hard to make. They get a lot of recurring revenue, and as well, they get service revenue from maintaining the contracts, software upgrades, spare parts, that kind of thing. We covered it last time, but their moat is basically they've got a monopoly in extreme ultraviolet lithography. And although someone else could, in theory, come in and have a go at it, it's unbelievably expensive to get into. They've got decades of research ahead of you. They've made loads of investments in R&D. They've got these exclusive supplier relationships. So even if you're able to get the parts, you would have to deal with the fact that they are exclusive suppliers for a lot of customers. So breaking in would be difficult. They've got a lot of patents you need to get around. And as well as that, it's just really, really complicated and really expensive. So in theory, although someone else could do it, there's probably a handful of companies in the world that would even be inclined to make the effort. And even then, it would take them years to catch up. So it does look like, without knowing much about the technology, that they do actually have a very real moat. They have come out with their second quarter results, and they've reported a 23% rise in revenue to 7.7 billion euros, and that's up from 7.5 billion expected. Operating income rose 45% to 2.7 billion, and that's up from 2.4 billion expected, with a margin of 34.6%. And new orders were broadly flat at 5.5 billion. Performance was driven by upgrades to the expected installed base, one-off cost benefits, and a less severe tariff impact than expected. Free cash flow fell 17% to $319 million, and there was net cash on the balance sheet of $3.6 billion. Management expects third quarter revenue to be between $7.4 and $7.9 billion, and operating income to be around $2.4 billion. These are both below analyst expectations. And looking further ahead, they've said growth in 2026 is uncertain at this stage, with management calling out increasing uncertainty driven by macroeconomic and geopolitical developments. So analysts had been expecting 7% growth for 2026. However, the forecasts are probably going to be reduced following this. And it's worth noting that ASML relies on US manufacturing for sections of its machines, which are subject to export restrictions. In recent years, they've done very well because China have been stockpiling a lot of the machines due to anticipated restrictions on the exports. So that has given them a boost in future years. In terms of valuation, the business trades at a forward PE ratio of 28.2. That compares to a 10-year average of 30.1, has a prospective yield of 1.1%, and that compares to a 10-year average of 1%. I think, again, similar to last time, I don't know loads about this business. From what I have read about the moat, it does seem very real. I think it seems like a very, very high quality business. I think these results are excellent. However, I appreciate a lot of this is geopolitical, but for a company that's already of this size, I'm not sure I'd be comfortable paying a forward PE of 28 for a business that's expected to grow at under 7% this year. I appreciate when you look at the year it's just had, this year could be a one-off, and I think it does have a very real moat, so it probably does command a premium because of that. I think it is in a market that is probably going to do very well. So I think if someone were to make an argument for it, I could kind of see where they're coming from. But for me, there probably is a price at which I would consider this, but I think it'd probably be in the teens, which I don't think it's anywhere near. I think unfortunately the market has a very high opinion of this business, and I don't think they're incorrect, but I just wouldn't be willing to pay up for it. What about you, John?
Yeah, no, I mean, I think it's an incredible business. It's not one I would still think I fully understand, but the times that we've covered it now, it being a couple, it does look absolutely fantastic. If you look at it and break it down in terms of its revenue source or revenue sources, so Taiwan Semiconductor Manufacturing Company, so TSMC, that accounts for around 30 to 40% of its revenue. And then a further 20 to 30% comes from Samsung, and then around 10 to 20% from Intel, and then the rest, the other smaller ones, around another sort of 10 to 20%. In terms of EUV lithography, it's a monopoly. It's just got the whole market. There are no other competitors. DUV, there are some, but they are fairly minor. And in terms of DUV, there's a little bit more competition from Nikon, Canon, and SME, which is a Chinese competitor. But ASML still dominates there with over 60% market share. So I suppose it is a fairly high valuation, but for a business with the sorts of moats that it has and on a growth trend and seeing that chips are the way forward and there's more and more demand for them, you can see how you get to that sort of valuation. I'm probably not brave enough to actually pay up for it. I'm sure, given the size of it, it's in index funds that I hold. But yeah, it is pricey, and it's got a huge market cap already.
Good enough for the watch list?
I think so, actually, because it's come back a fair bit over the last sort of 6 to 12 months. So yeah, I think it is good enough for the watch list, absolutely.
Should we move on to our US company then?
Yes, so Netflix, which is, as everyone knows, the online streaming giant. We've covered it quite a few times, and it's been a bit up and down, a bit of a roller coaster with Netflix. So we first started covering it back in COVID times when it was absolutely booming, and then pulled back a lot in 2020. Well, I think 2022 particularly, but late 2021, 2022. And I know we'd looked at it, and it had been one of those FANG stocks, and then it almost sort of disappeared from that, and it was like the sick man of the FANG stocks. But it has come back, and it's had its second quarter results out with second quarter revenue of $11.1 billion, up 17% when ignoring currency moves. Operating income rising 45% to $3.8 billion, with operating margins improving from 27% to 34%, both ahead of expectations and driven by higher revenue and the helpful timing of some of the costs. Free cash flow rose 87% to $2.3 billion, with net debt ending the quarter at $6.1 billion. And third quarter revenue is expected to grow by 17% when ignoring currency moves, with an operating margin of 31%. And full year revenue guidance has ticked even higher, given favourable currency moves, to between $44.8 and $45.2 billion. Previously, it was $43.5 to $44.5 billion. And shares were down nearly 2% in late or overnight trading. In terms of valuation, Netflix has a market cap of $514 billion and trades at 44 times forward earnings, doesn't currently pay a dividend. And I thought, wow, absolutely stellar results, really impressive growth with the quality content. The churn has been significantly reduced. I know that had been one of the big worries that had been dominating the company in the past, albeit with quite expensive content to produce. The ad-supported version doing very well and incredibly popular, generating decent growth for the company. And I think probably reflecting back on it, now that we've seen how it's been coming to do over the last few quarters, I think it probably is a much higher quality business than perhaps, well, certainly than I'd given it credit for, and not really appreciated the consistency of the quality of the content in that really competitive environment that we'd looked at a few years ago. That being said, and it's sad, I wouldn't pay 44 times forward earnings for it. Going back to sort of 2022, 2023, should I have paid up for it then? Probably. But that was without a realization of just how good some of its original content and the consistency that it's able to produce that at is. And I think that's for me was the difficulty, and why I didn't pay up at the time. But certainly now it looks very, very expensive. But when you've got results like these, you can see why the market it has had that drastic revaluation. Sam, what are your thoughts on these results and also Netflix's current valuation?
I think the results, you can't knock them. I think they're a perfect set of results. I don't think you could expect it to have done any better in any respects. I think I'd question anyone who's buying it at this level, and I think for it to sustain those results, and justify and to give someone a market-beating return who's paying 44 times earnings from such a high base, I think is really, really tough. I think if you're interested in the company, you probably should have bought it 3 years ago when you had a good opportunity. I feel like you're being a bit harsh on yourself for not buying it when we covered it 3 years ago, and it was about 20% of the current price. Because I just think it was very unclear at that point whether the increased churn and stuff was the start of a wider trend, whether it had peaked. It had a lot more competition with Disney Plus that had just been rolled out, and that had been rolled out very positively in the last couple of years prior to that. And I think as well, even though it's had a few years of really good content, there is also the issue is that if it has a year or two where it misses on a few big hits, that churn could go back up, and it could end up in its own way being a bit of a cyclical, where people are turning on and turning off depending on what content there is they want to see. So I'd still, if I could go back, I would obviously have bought it because I would have 5x my money. But with the information I had at the time, I don't think the decision that we made was unreasonable.
No, it's always easy in hindsight.
Exactly. So of the 6 businesses that we've covered then, Ocado, Barratt Redrow, Trustpilot, Experian, ASML and Netflix, which one do you like the most? Which one do you like the least?
So it's fairly easy to go for Barratt Redrow. For me, in terms of valuation, that plays a large part in that. I think a close second would probably be ASML. I think that's a fantastic business. It's still fairly pricey, but the quality of that, I think, beginning to appreciate that much more. Last is fairly easy. It would be Ocado.
So I would agree with Ocado at the bottom. I think, that picks itself, really. I think, for me, my top pick, I think I'd actually go with ASML. Trustpilot, Experian, and Netflix are all excellent businesses, but they're all too expensive. ASML is probably too expensive for me, but it's got the most stomachable valuation. Whereas I think with Barratt Redrow, although long term I do like it, I just think at the current yield, given it's probably mainly an income play at the moment, I think I'd rather pay up for ASML, actually.
Fine. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.